Welcome to Tradespoon. My name is Vlad Karpel. I'm CEO and founder of Tradespoon, and today we're going to have a weekly strategy roundtable discussion where we talk about current market conditions, any questions you might have about your subscription, what to expect short-term, medium-term, long-term in the market, has the market bottomed, and how long will this recovery last. For those of you who are new, welcome. If this is your first live event, do me a favor, type in first. Always want to welcome new subscribers. This is my brief bio. I was Executive Vice President, Head of Technology at Options Express from 1999 through 2007. Options Express was an online broker-dealer acquired by Charles Schwab. Since I left Options Express, I work as a consultant and investor in several financially technology companies in Chicago, and several startups. Started Tradespoon in 2012. I want to take this opportunity to say thank you to all the subscribers. Because of you, I'm able to do what I enjoy professionally, managing and trading my own money. I've been doing that for over 15 years. Mentoring and teaching subscribers how to trade stock and options. And finally, I have a master's degree in computer science, specializing in statistics and artificial intelligence. Disclosures. Trading stock and options. Disclosures are very important. If you're new to trading stock or options, I encourage you to visit optionscreening.com so you can understand the risks associated with trading stock and options. I'm not a financial advisor. I'm not registered with FINRA nor SEC. I'm showing you what I do in my own account, based on my own risk tolerance level for general education and information purposes only. Please consult your financial advisor prior to making any trading decisions. Also, it should not be assumed that the future trade picks will be profitable or will equal past performance. Right, before we get into trading plan, and trading psychology, let's talk about current market conditions. So first, I mean, the most important question, right? The most important question is that everybody wants to know, right? Maybe I'll pose that a question. What is the most important question in trading right now that everybody kind of wants to know? Anybody's guess? My wife wants to answer. Yes, Galina. Where is the bottom? Thank you, Mark. Yes, where is the bottom? That is $1 million question that everybody is asking, everybody's talking about. So, you know, it's an important question, right? It's an important question because it does determine if you're going to invest or if you're going to trade, or, you know, what your time horizon is. So it's all over the news, right? This favorite Fibonacci retracement. Let me just make sure you guys can see this. Make it a little bit bigger. That might be an issue since. So we're going back to, let's see. Right, so if you retrace the last kind of bear market, right, the start of the pandemic from March of 2020 to the current, to the 52-week high in January, December of this year, we reached yesterday exactly 50% retracement, right, almost to the dot, 349, 350 level. And also corresponds to the elections after our president was elected, right, back in November of 2020. We are back to that level. So basically, all of the gains kind of were wiped out since the elections, right? All the gains wiped out since the elections, and we're at 50% retracement. All right, so very important key level. And the question is, just like Mark says, is this the bottom, right? Is this the bottom? My answer to this, well, depends how, you know, the bull's argument, let's go over the bull's argument, why it is the bottom, right? So the bull argument why it's the bottom, they're basically gonna say that we had really bad CPI data, really bad PPI data, right? The inflation is stubborn, it's here to stay. Fed has no choice but to continue raising interest rates. And the market sold off after the announcement, 2%, almost 3%. Spiders were down as much as 3%, new lows, 50% retracement, 348, and it rebounded back to 367 level. So 3% down, almost 3% up, 6% move. Last time in the history of, I think, is in the stock market, there's only 4 occurrences of such a large reversal. Last one was back in 2020, and then in 2008. So every time, there's only been 4 occurrences of such a large reversal on large volume, right? We had this large movements in volume, and historically, 1 week later, 1 month later, the stock would continue to go higher, right? So that's the bull argument, right? That we are down, 20% on spiders, 25% on QQQ from the last high, right? June, July high. Sorry, July, August highs, and the VIX reached the 36 level, right? That's where there is a lot of overhead resistance in terms of volatility and uncertainty. What does it mean, VIX 36 for the past 2 years? It means that everybody anticipates the market is going to break, and everybody's hedging, buying a lot of puts, right? So in this environment, it's very hard to push the market all the way down, right? So that would be the bull argument, and then they would look at the 2-year yield, right? 2-year yield. We briefly broke through the 52-week high, pull back. It's actually high right now, and then same thing with dollar. We're not at 52-week high. We actually retraced and pulled back. So looking at the volatility, looking at the fact that the market rallied on really bad news, basically the argument is there's no more sellers, at least for now, right? All of the people who wanted to sell and who don't want to hold the position, they kind of capitulated, right? Mini capitulation, right? VIX hasn't reached really extreme levels, so at least mini capitulation. So that's basically the bull argument, right? The bull argument that this is maybe not the bottom for the entire, for the next 12 months, but this is a short term is the bottom, maybe for the next couple months, right? Going into the midterm elections and going into the end of the year. So let's vote, right? We're here to kind of learn and vote and not to fall asleep. So one is, is this the bottom? Bottom. I'm going to have 2 questions. One is this the bottom for 2022? So let's answer yes or no. So is this at least short term the bottom? Like for the next few weeks, for the next few months, we kind of reached the bottom, and the market, the path of least resistance is to continue going higher. How many of you say yes? And how many of you say no? Oh, Mark said, when is the bottom? Not where is the bottom, when is the bottom? Okay. So, no. Okay, so this is just the bottom for this year. Mark said no, trader no. Joseph says yes, a bit more to go. No. Okay, so most of you said no, which is, that's the answer I would expect, right? Because the market sold off, we had mini capitulation, everybody's concerned. So you do have this kind of a crowd effect, right? Herd mentality that, there's no way this is the bottom of 2022. So majority of you said, 75% of you said, no, that's not the bottom for 2022. I'm going to say, yes, it is the bottom, right? I'm going to say yes. And when I say it's the bottom, I mean, can it reach, we had 350, can it reach 345, 340? Maybe. Very unlikely in my opinion, but maybe. But, there's very little room to the downside, right? I think to the downside, okay, we're at 361, 350. Okay, so you have 10 points to the downside. All right, 10 points to the downside. And I think we can reach 400 level by end of the year, right? Plus 40 points to the upside. So risk versus reward, in my opinion, is very favorable. So at least if you're a tactical short-term trader that thinks in weeks or thinks in months, you have 10 points to the downside, 40 points to the upside. It's 1 to 4, 1 to 2. This is very favorable conditions. if you're aggressive short-term to medium-term trader, to go long. So I'm going to put this contrarian view. So I'm going to say yes. I think this is the bottom, or very, very close to the bottom. Maybe it was in 1%, 2%. The second question, let's start answering the second question. Is this the bottom? So is this? So is this the bottom for 2023? Okay. So the second question, right? In trading, especially if in a bear market, by definition, we are trading in a bear market. I don't think that you will find many people who don't think we're in trading bear market. By definition, bear market is a trader's market, right? In the past, since 2008, it was investors' market, right? Passive investor outperform active investor almost consistently for the past 12 years. Now, it's the other way around. Active traders outperforming passive investors. What is the definition of active investor or active trader? Is that you have a sense of direction, magnitude, and time, right? You need to, when you're trading the market, you do have to think in these vectors, right? Like going back to, I don't know, calculus class or physics class, right? When you trade, you have to think in one direction is time. You have to think about time. You have to think about direction, right? And you have to think about it in magnitude, right? And the resultant of these three vectors will determine, where you're going and, how fast you're going to get there. So the question number two, let's pose it. Is this the bottom, for this year and also next year? Yes or no? How many say yes? How many say? No, Mark, thank you. No, no. Okay. Anyone else? No. Okay, so I'm gonna say no too. I agree, right? So short term, I think we have reached the bottom or very close to the bottom. Long term, the bottom, there is no bottom. Right? We're not the bottom, right? We're not close to the bottom. Like Jamie Dimon said, I think now he actually during the press conference said that very likely we're gonna hit hard landing. And then 3 days ago he said, well, if we do hit hard, if we do have hit hard landing, then market can easily sell off 20%. And today he actually, like a few minutes ago, said, well, nobody knows. I know just as much as you do. And that's a really good answer. I like that answer. That nobody knows whether we're going to hit the hard landing or whether we're going to hit the soft landing. We can have an opinion. You can have an opinion. You can invest money based on your opinion, but that doesn't mean it's going to happen that way, right? Everybody thinks recession is going to hit next year. Maybe we'll hit in 2024, right? We just don't know, right? And plus, nobody knows what's the definition of recession, right? It's a body of people that lock themselves in the room and then they decide whether we're in recession or not. And that definition changes all the time. So that's a really good answer, right? That's a good answer. Nobody knows, but in trading, you have to have an opinion and you have to, kind of invest based on opinion. In a bear market, even though I don't think this, I think this is the bottom for this year, but it doesn't mean that I'm right, right? That's my opinion. I think there are some signs that I outlined that we have reached the bottom, but anything can happen in the market, right? Britain defaults on its debt, right? Or they are doing too much quantitative easing, or they're doing quantitative tightening, or that contagion can spill over to Credit Suisse Bank and Italian debt. Then the market will sell off, and we have we have not reached the bottom this year, right? So that can happen, and that's why I wanted to kind of illustrate. I'm reading this book. I reference it in the live trading room. I don't know if you can see it. I'll try to make it better, right? So this is the Ernest Shackleton, right? Biography of Ernest Shackleton. This is the trip to Antarctica, right? Shackleton voyage, 1914. book endures. If you haven't read it, I encourage you to read it. I don't know if you can, let me try to figure out the zoom issue. I like that map, but the zoom is an issue. All right, but anyway, so this is an expedition, right? 1914, you know, on the verge of World War I. I think World War I actually has started. All right, so the Shackleton is trying to get to the South Pole, right? He's going through Argentina, and then he's taking a voyage in Weddell Sea, right? In Antarctica with the idea to get into Antarctica. So the voyage starts in December 1914. Let's see. Maybe I need to just change. Sorry, I'm trying to get to zoom this. Here we go. Okay, sorry about that. All right, so the voyage starts in 1914, right? December 5, December 7 enters pack ice, and then January 18, 1915 is trapped in the ice, right? The ship is trapped in the ice, right? And then you go into drifting with pack of ice, right? Endurance is crushed and abandoned, right? October 27, noticed from December to October, almost a year, right? It's almost a year. It was drifting back in the ice. Then eventually the pressure of the ice, you know, collapsed the ship sunk, and then the crew has drifted on the ice, right? And the book describes their journey, the struggle, you know, the weather, the temperature, how desperate people can get if they, you know, just imagine you're stuck on the ice for 2 years, kind of drifting in Antarctica, and you have, you know, sometimes you have food, sometimes you don't have food, sometimes it's a 24-hour-a-day night, right? Sometimes it's a 24-day hours a day, right? Sometimes there is no sunlight, and sometimes, like for months, and sometimes there's no night for months, right? And then how much, you know, their journey of the crew and their struggle, right? So it's a really good kind of motivational book. I encourage you to read it, right? And then, you know, the crew finally, you know, go to the Elephant Island and they get rescued, right? 2 years later. So this is a very good analogy, right? And they have a team of very experienced, you know, sailors, very experienced. They have physicists, they have doctors, they have scientists. They're looking at the pressure, they're looking at the wind. They're trying to predict when will they get to the South Pole, you know, how much west they're gonna go, how much north they're gonna go, when will the ship collapse, when it will not collapse. So try to make all these predictions, and they're very smart, best of the best, you know, crew for that time. They have the best ship for that time, and nonetheless they're been always wrong, right? They thought it was in 2015. No, it happened in 2016. They thought it was in, you know, March. No, it happened in June. So they were off, and the journey continued on. The whole thing was, you know, almost 2 years, right? 2 years, and the ship collapsed, I think, like 8 months later, where they thought it's going to collapse 3 months later. So I think this is a good analogy. I would encourage you to read the book, but also, why do I mention this? Because trading it's a voyage, right? Trading is a voyage, right? The ship is, you know, I don't know what the good, it's our economy, right? You know, our economy is kind of trapped, right? And, you know, you know, ship is a tool, but the people, right? The people are our economy, right? The screw is our economy, right? And they're trapped on this ship inside of the ice, right? And our economy is trapped, right? And you can see that there's the signs that the ship, you know, might sink, right? But trying to predict when the economy is going to collapse, right? You just don't know. And the idea of this book is that people who have faith, right? People who are patient, people that can visualize what their goal, right? They have family, they know their family is waiting for them. These are the people that survive, right? These are the people that they're patient, they have great leadership skills, they have great, physical skills, intellectual skills, and together as a team, right? Under great leadership, they're able to navigate the adversity and persevere and make it to the other end. Trading is the same thing, right? You have to have patience. You don't really, it is a voyage. You don't really know when the ship is going to collapse, right? And when the ship is going to collapse, right? That's our, bull market. Think of bull market as we've been in bull market for the past 100 years, right? Market always continues on, right? But right now, the bull market is trapped in the ice, right? It's trapped in the ice, and it's just a matter of time for this ship to collapse, right? And you already can hear the noise, right, under the pressure of the ice, right? Credit Suisse, has liquidity issues. Italian bonds are, the credit spreads are at, historical highs. Britain is entering the recession. Germany has CPI above 10%. So and you can turn on the news and, I don't have to explain you all of the signs, right, of, high inflation, persistent inflation, high interest rates, liquidity issues. So you can hear the noise that the ship is under pressure and about to break, but you have no idea when it's going to take. And this journey can take, 30 days. It could take, they thought they're going to be done in 3 months, but it took them 2 years. Right. Same thing with inflation. We think, initially we thought it's going to, by end of the year, the inflation is going to be over and off we go, right? We thought it's going to last 12 months. Now it's clearly that it's been 12 months, or potentially more. It's already been 24 months. It could take another 12 months for inflation to subside, right? It could take 18 months, right? So the idea is that you have to be patient. You have to do the best you can, right? The crew would constantly try to navigate and avoid risks, right? If they see too much water in the ice and the ice is fragile, then they would change their camp, right? They would move their camp and they would stay there, right? They would preserve the food, right? They would freeze the food, so in case the food is not available, they have some reserves, right? So the idea is that process versus outcome, right? The idea of, we were referencing, dichotomy of control, right? Stoic idea of Stoic philosophy, right? Dichotomy of control. For Shackleton, right? For this voyage, for the traders, what is dichotomy of control? Is that we can only control, right? Things that within, we can only control our actions and thoughts, right? We can only control things that we control, our thoughts and actions. Everything else we cannot control, right? The team that was stuck on this journey, right? The only thing that they could control is, what do they do every day? Do they play cards? Do they position their camp? Do they preserve their food? Do they hunt? But they don't have a control which way the wind is going to blow and where is it going to take the ship, right? Same thing with the trading, right? You just don't have the control, but there are certain things you can do, right? And that's the idea of thoughts and actions. So we can control our thoughts and actions, and we can control how do we prepare for the bear market. So I propose, what can we do, right? Assuming that the economy is stuck in this ice and we don't know which way the wind is going to blow, how do we prepare, right? How do we, prepare for the worst and hope for the best? One is cash, right? I think the rule number one is to have cash, right? Just like you need food if you're stuck in the ice for 2 years, you need cash. If you know that we're in a bear market and you're stuck, and you might be stuck for 6 months, you might be stuck for 12 months, you might be stuck for 18 months, you have to prepare for this long winter, right, ahead of you. So how do you prepare for the long winter ahead of you? You stock up on cash. I propose 50% of your portfolio in cash. In the bear market, I would say 30% of your portfolio cash. The slide hasn't changed. I keep saying that I'm going to update it and I keep forgetting. But okay, it's 30% in the bull market. In the bear market, it's 50% of your portfolio in cash. Second one is the portfolio drawdown. Very important concept. What is the portfolio drawdown? Is number of positions times your exposure for each of the positions to the market, right? Well, how much risk are you willing to take? So 4 positions times 2.5% of account value per position. What does it mean? The reason I choose 4 positions because right now, if you read the news or you go on Twitter, everybody's saying everything is very highly correlated to each other. Whether you trade in banks, or you trade in technology, or you trade in consumer staples or energy, everything is correlated. Yes, you can have some divergences, right? You can have a divergence where today, let's say, we're in the middle of the earnings, right? Not in the middle, just earnings just started, right? Banks, we had yesterday, and then banks announcing earnings today. So you have JP Morgan up 2.5%. Citigroup, Wells Fargo is up 2%, but Spiders is down 1%. So your initial inclination, well, let's just buy, push all of our money into the banks because, banks are obviously going up and Spiders are going down. So I'm going to chase the stocks. The answer is yes, there could be divergence, maybe today because they announced earnings, and maybe this divergence will last for another couple of weeks, right? You can squeeze a little bit more out of JP Morgan or Wells Fargo, but few weeks from now, few months from now, that divergence is not going to last that long, right? JP Morgan will follow the Spiders, right? Spiders will not follow JP Morgan. JP Morgan will follow where the Spiders are going, right? They're highly correlated. So for that reason, I propose to have only 4 positions. The second is 2.5% of account value per position. Why 2.5%? Again, interest rates are moving as much as the market moving, right? So interest rates move more than Bitcoin moves, right? They're more volatile. So certain asset classes are going to be more volatile than the other, right? Delta Airline is up 3%, but BlackRock Group is down only 0.5%, right? So maybe BlackRock Group is not as volatile as Delta Airline, right? So then you have to adjust for the volatility. But the point is, doesn't matter if you buy in Delta Airline or you buy in BlackRock Group or you buy in something that didn't move much, Dow Jones component that only down 0.5%. The idea is that no matter what you're trading, you don't want to risk more than 2.5%, right? There's a certain amount of risk you want to take, right, without jeopardizing the entire journey, right? And this is the story of Shackleton. He's a big risk taker, but certain things he did not want to do, right? He did not want to allow any of his members to go on their own to look for water so they can escape, with the boats, because he was concerned that they can get lost and nobody can help them. So he had these rules where, okay, you can take the risk and go on a journey, but you have to have a certain number of dogs, certain amount of food provision, and a certain number of people, right? So it has to be well-defined risk, but you should not be to a point where you're taking too much risk. So in my mind, too much risk is anytime you have more than 4 positions and you're risking 2.5%, right? How do you determine that? Right now, I propose, well, you know where the bottom is, right? We talked about the bottom. The bottom is 350. And maybe it's not, but it may be the bottom, maybe it's close to the bottom. So if you're a bull right now, right? If you believe that, okay, market can rally, I like this 4-to-1 risk versus reward, you buy in Spiders or you buy in JP Morgan or you buy in Delta Airline, whatever you're buying, especially if then Delta Airlines had a good earnings, so maybe it makes sense to buy Delta Airlines. Pepsi had a good earnings, maybe it makes sense to buy Pepsi. So, but your risk is always the same, right? $250. Doesn't matter if you bought Pepsi or you bought Delta Airline. This is your stop loss is 350. All right, so the way my thought process is, I always journal, right? The idea is to internalize this information and make it a repetitive process where you build confidence in yourself as a trader and you have discipline, right? How do you build confidence and discipline? By repeating these tasks over and over again, right? If you're stuck on the ice for 2 years, well, okay, then for 2 years, you just have to get up every morning, you have to eat breakfast, and then you have to, a lot of physical labor, right? A lot of physical and mental labor to survive for 2 years. Trading is the same thing. It is an intensive process. You have to, it's not just like surviving on the, it's not as intense as surviving on the ice, obviously, but it's a learning experience. It's still process and it still takes time. So to internalize this, you need to journal. I encourage everybody to journal. I would make an argument if you never journal, or if you did journal, but when you journal, your performance will be better. If I plot the time when you journal in your performance and when you don't journal in your performance, I'm going to make an argument that I have 90% confidence that your performance goes down when you don't journal, right? Because when you don't journal, you don't internalize information, so you forget, you make exceptions, you're not as disciplined, you get caught in the bear market, and et cetera, right? So if I plot your performance versus journaling versus not journal, right, two graphs, right? Whatever your performance is, this is when you journal, and this is when you do not journal. At least for me, I know that. I've done this experiment many times. So I encourage you to journal for the reason of internalizing, reviewing, and committing this into, these process into the memory. And in the journal, you basically write down, I want to buy spiders at 363. I believe it's not going to go below 350 or 345. Maybe you give yourself a little bit of room. So you're saying, okay, I have 20 points to the downside, right? Maybe I have the maximum 20 points or 15 points, right? I say I have 15 points to the downside. I have, let's say, 40 points to the upside, right? And this is my stop loss, 15. What does a 15-point stop loss mean? Average account at Tradespoon is $10,000 based on the survey, based on I just know retail account average is $10,000. Yes, there is account with $500. Yes, there is account with $5 million, but these are outliers. Majority of accounts that last, at least a few months, at least $10,000, right? So $10,000, not at least, average. I don't want to, average is $10,000. So then, you multiply by 2.5, that means $250. So if you want to buy spiders, or if you want to buy Pepsi, or if you want to buy Delta Airline, or you want to buy Wells Fargo because it had a pretty strong earnings, great. You don't want to risk more than $250. So then you look at the chart of spiders, and this is your exit point. Whether you're in JP Morgan or you're in Citigroup, if spiders break below 350, right? They're at 330. JP Morgan is also going to be at new lows, right? And Citigroup and Nvidia and Tesla, they're all going to move in tandem. So those are that's the stop loss, right? And if you're risking 15 shares, if you're risking 15 points and the maximum risk is $250, that means you can buy 15 shares, right? You can buy 15 shares roughly. And you multiply it by 15 points, right? And that's your 200. That's how you determine stop loss. And you write this down. And then if we do hit, let's say 347, then you exit your position because you're down $250. And then you would grade yourself A or B, right? B if it hit 347, and you grade yourself A if it hit 400. Let's say you drop to 330, but you held on to your position. You're now down $500, and then it reverts to 400. Okay, then you grade C or D. Sometimes you break your rules, you'll get a C. The trade will go in your direction, so you put a C. And if it doesn't, then you put, and if you broke the rule, but you lost money, then you put, C or D. So grading yourself, right? That's what builds the process, and that's what builds the discipline. And it works for me at least, and I know it works for majority of traders, right? We work with trading psychologists, Dr. Maneker. He's been coaching, the best traders in the world, right? People who are like superstars in their hedge funds. Everybody, there's always common theme, right? You're not going to find a good trader that doesn't have a well-defined plan that's written down, where he journals and he commits, and he has a routine. He doesn't break the rules. I mean, everybody breaks the rules, but it's an exception, right? It's not a norm. So, any questions on number of positions and stop losses? So that's the most important rule, right? So number of positions. All right. Thank you, Kent. Growth was failed upward trend open. I said yesterday, I'm thinking that's buying problem. Then Biden Thank you, Kevin. Kent. Thank you. Yes, recession is whatever politicians decide. Thank you. I think I show on him on Discovery. Kevin, okay, great. I assume it is. I didn't see the story on Discovery, but Kevin, I assume it is. Mark, perfect. Thank you. Yes, from Mark from Park Ridge. Have fun in Colorado. Buying Google and holding for long term. All right, so perfect. Chuck had a very good question, right? Buying Google for the long term, right? So again, I don't know how long this voyage will last, right? Just like Shackleton didn't know how long it's going to take him to rescue, right? He probably was extremely sure. He thought it would take him, always double your estimate, right? He thought it was a year. It took him 2 years, right? So if I think that inflation is going to last another 12 months, I should multiply by 2. Even though I think it's 12 months, it'll probably take 25. If I think inflation will substantially drop in 2023, let's go with 2024. So if we're going in 2024 and Spider, and this is not the bottom, right? It doesn't matter, Google, NVIDIA, Microsoft, Rivian, whatever you ask me, I'm going to give you the same answer, right? Except the dollar, right? And except inversely correlated, right? There's inversely correlated asset classes and directly correlated. Google, Microsoft, NVIDIA, they're directly correlated to the stock market. So if this is not the bottom, and Jamie Dimon is right, we're easily 20% away, right, from the bottom, right? So that means the current estimates are that the spider will reach, well, 360 minus 20, right, roughly 70 points. We reach 300. So a lot of people basically right now calling 300 because they assume 2023, if the inflation actually lasts 24. That's like core scenario now. The core scenario right now, if you think there is a hard landing, that spiders will reach 300. The worst case scenario, just like the voyage, and I'm not implying that market, the Shackleton voyage doesn't have to be this way, but it could be, right? It could be that if it's not 2023 the bottom, but 2024 the bottom, well, then we're going, probably to 250. So then the point is, if the core scenario is 300, and the worst case scenario, we are, 270, right? Then buying Google is probably not the right strategy for long-term investor. I would not buy Google, especially something that's exposed to marketing, right? Consumer discretionary. And you know that if we are in the recession, that the first thing that the companies cut is, marketing budget, right? So pay-per-click, where Google derives most of its revenue from pay-per-click, that will substantially go down, right? So that would be my answer, right? But not everybody is like me, right? You can be in soft landing. If you're in a soft landing camp, right, then we are close to the bottom, right? Or maybe this was the bottom, right? Or maybe it's 325. I don't know. Then the answer would be, if you believe in soft landing, that that inflation will substantially drop next year, and at some point, sooner than later, Fed will pivot, and it will not create systemic issues where the revenue, the unemployment is going to go up, and the companies will continue making money. If you're in soft landing, then you can buy Google, because we're probably close to the bottom, right? But I still encourage you to use dollar cost average. Maybe you buy here. I would buy maybe 30% of your position, right? My goal is not to lose $250, right? So if you buy on Google on a $10,000, idea is not to lose more than $250. Okay, so you buy in Google here, right? Because you think, the worst case scenario, we're going to be here. Let's say we reach this level. Maybe you say, okay, fine, Vlad, I believe you. Maybe we'll just reach 324. So again, 40 points down to 150. I'm using Spider as an example. Google would be it's the same chart. If you do the weekly chart, they look very much similar. So on the $361 stock, well, let's do Google just so we're clear on example, right? So let's do Google. Right, chart looks very similar, right? It actually broke through the 50, so it's weaker than Spiders. You basically think we're close to the bottom, maybe 89, right? So same process, right? Same process, right? You soft landing 90, right? Okay, so you're risking 10 points, right? You're risking 10 points, right? From 100 to 190. So you can buy 25 shares, right? So if you're, right, you're buying 25 shares. If you think about long term, and if you're in a soft landing camp, I encourage you to maybe take this and divide it in 33% increments, right? You buy 8 shares now, right? You basically said, Vlad, you don't know, Shackleton doesn't know, Biden doesn't know, Powell doesn't know, Jamie Dimon, no, nobody knows. So then I'm going to buy 8 shares, right? Because nobody knows. We could be soft landing, we could be hard landing, doesn't really matter. So you buy 8 shares now. And then, if market does drop to 90, or maybe even, next level of support will probably be here, 85, right? So then you buy 8 shares again, right? And if it drops to 70, because it is exposed to, if we are in hard landing and the market is down 20%, well, Google is probably going to be down 30%. So then you buy another 8 shares, right? Two things are going to happen. Soft landing, the market is going to do this, right? Hard landing, the market is going to do this. In both cases, you are happy, right? The idea is to predict how you will feel in the future, right? I can tell you that if you're losing more than $250, right, most of the likely you're not going to be happy when the stock is going to go down, right, 30%. But if you bought 8 shares and the stock went down 30%, you're going to be extremely happy, right? I know that. I can predict that with high certainty. If you buy 8 shares and the stock goes up and it's soft landing, yes, you're going to say, Vlad, because of you, I didn't buy enough shares. A lot of people tell me that. But okay, so you didn't make $250, you made $80, right? Or something along those lines. But I know you're going to be happy in both cases. You're going to be happy if Google goes to 140, and you're going to be happy if the Google goes to 70. If you buy 25 shares, right, and you down, and we reach 770, and instead of down $250, you're down $1,000, most likely you're going to capitulate, right? You're going to exit out and say, listen, this is not for me. I had enough of this, and you're out, right? So I'm trying to encourage you to try to predict your own actions, right? And we're all different. There's no such thing as like we all have different DNA, all different cultures, background. We all speak with different accents or no accent. It doesn't matter. We're all different, right? I don't know what that tipping point, but I know every human has a tipping point, right? Whether you're down $250, $500, $1,000 on that $10,000 portfolio, at some point you're going to say enough is enough and I'm out. So I encourage you to kind of try to predict, try to learn about yourself when you're gonna capitulate and avoid that. And the only way to avoid that is go through this exercise, right? Either you don't buy any shares or you buy 8 shares, right? On a $10,000 account, it has earnings in a couple of weeks. Let's say it's dropped to 90 or 85, you buy another 8 shares. And then maybe by end of the next year, when it's at 70, you buy another 8 shares, or June or March, whenever that event happens. Very important question, very important discussion. I hope this makes sense. If it doesn't, please ask questions. Well, if the bottom has been reached, the question can have a question, well, if we have reached the bottom, how far the QQQ will go? Again, we're trading in the bear market. Assuming that I'm right and this is the bottom, how far can it go? I think it's a lower high. The pattern, one of the patterns of bear market at lower highs, right? lower highs. So next level, if you judge them by these, 20, 25 point, I would say maybe 315, 315. So 40, 50 points. So no, it could be 20% move, right? QQQ, just like in June, July, it rallied 30%. Okay, now it's going to rally 20%. So I think QQQ can rally 20% from these levels. I don't think we're going to break it. We're not going to break this level, right? I don't think that's happened because we're in the bear market. But anything below that is a fair game. It could be 10%, it could be 20%, 20%. It all depends on this earnings season, right? As it unfolds. Any other questions? Clayton, open 2 naked 90-day calls. My coach does this. I mean, I would not sell naked calls. I would do credit call spreads. I mean, if you're a bear, I personally encourage, I personally would try to not hedge. I mean, obviously, this bottoming process could last a few weeks, right? So spiders, at least for now, is stuck in the range, right, between 350 and 380, right? Last week high and this week low. This is where the market has been trading for the past 4 weeks now. So for the past 4 weeks, it's been trading below 380 and above 350. So at 360 selling calls, I think it's a 50-50 chance, right? It can drop to 360 or it can move to 380 or 375, right? So for that reason, I would do at least credit call spreads. Yes, if 4 positions at 2.5%, you risking only 10% of your portfolio, right? We've seen markets reverse 7% yesterday. I mean, it could reverse 7% today, right, on news. You don't want to risk more than 10% of your capital. These moves, one thing that I do know with high certainty and high conviction, that VIX is going to trade in this 40 to 20 range for quite some time, right? Historical average is 20. Bull market VIX is below 20. Bear market VIX is going to stay above 20 for the next, I don't know, 6 to 12 months, maybe more, right? So if you know for the next 6 to 12 months, VIX is going to be between 20 and 40, and we're going to have these 20% rally, 20% sell-offs, you do not want to risk more than 10% of your portfolio, right? Because you could end up on the wrong side of the trade. You don't want to lose, for me, the trigger point, I'm down 20%. I think for majority of the people, if they see their portfolio down 20%, they're going to get emotional, right? They're going to get concerned, right? And you don't want to be in that situation. That's my opinion. Kent, okay, selling credit put spreads, again, think of it as a stock value, right? If you're selling credit put spreads or selling naked puts, what if you get a sign? It's the same thing. Look at your stop loss, 2.5%. You don't want to risk more than $250 on a $10,000 portfolio. Kent, thank you. All right, so how do we help? Except the psychology. At Tradespoon, we have different services, right? I encourage you to start with the services. I mean, if you're an experienced trader, you're confident, you have a great trading plan, you know what you're doing, you've been doing this, and you just want ideas, we have these tools and picks, right? Active trader, weekly trader, monthly trader is where we will give you the signals, we'll give you entry, exit points, direction, but you have to pull the trigger. You have to decide what you will buy and when. If you're relatively new or you just want to follow our portfolios, then I would do Elite Circle, Spread Trader, Shadow Trader, Premium Trader. Right? The difference is that a Spread Trader and Premium portfolio, these are only option spreads. Majority do not trade option spreads. So then I would encourage you to either Robo Investor or Elite Trading Circle. So in Elite Trading Circle, you have, you can see all of the examples, right? So today I'm, closing JP Morgan trade, right? I did the Iron Condor in JP Morgan, and I reinitiated the NOC on the pullback. I bought NOC. on a pullback. So that would be my strategy. That would be my strategy. To use a lead circle, you can always see all of my orders. You can always see my positions, right? This is an example of JP Morgan. And actually, when the trade went against me, right, because of yesterday's reversal, not only will I show you how to trade these iron condors, right, but I sold 109 call during the live trading room, and the market reversed 7%. The trade is going against me. I had a choice. I could have lose $250, right, because when JP Morgan reversed at 2 p.m., and reached 109 level, reached my short call, I could have capitulated and closed my account, close the position and lose $250. I was down exactly $250. I decided, because, you know, to hedge my portfolio and try to save the trade by buying the stock. So now I'm in cover call. I have 109 short call, right? And then I have a stock. So if the stock goes higher, or it doesn't go down by more than 2.5%, right? It doesn't go back to 107, then, you know, I'm not risking any additional capital, right? So I'm hedged for 2.5%. So this is a perfect example where I got into a cover call. You know, stock is trading at 113. You know, doesn't matter if it goes higher, if it goes lower, as long as it stays above 109, I'm able to capture my 52 cents premium on the call, 56 cents premium on the put, dollar. So I made 1% by holding position overnight, right? And that's an example of compounding investing, right? If you can make 1% on every trade, you know, and you're averaging, let's say, 75% accuracy, that means you have 3 trades, right? If you did 4 trades this week on earnings or similar trades, spreads, doesn't matter. Let's say 3 trades you made 1%. Let's say, you know, yesterday I didn't buy the stock, so 1 trade you lost 1%. Fine, right? That's been my average. So that means every 4 trades you can make 2%, right? You might say, well, Vlad, what is 2% on $10,000 account? $200, I mean, it's not going to make or break or make any difference for me. But if you can make 2% a week, you know, then compounding investment basically said in months you're going to make 24%, or sorry, 8%. In a year you can make 96%, right? If you can make 96%, then all of a sudden, you know, $200, $100 doesn't sound like, you know, a small return, right? So that's the mindset, right? Larger portfolio, maybe you look for 0.5%. You know, smaller portfolio, maybe you have to take more risks, so you look for 1.5%. But that would be the strategy, right? Compounding investing, repeating this trade. Elite Circle is something that you can follow all of my orders, all of my positions with SMS message. You can be part of the live trading room. So I encourage you to participate that, you know, and do 1 or 2 trades a week when you start. I mean, I do more, but you can start with 1 or 2 trades a week, maybe just to learn the process and build that confidence. All right, any questions on the market? Any questions on the Elite Circle? You do have to have 100 shares. So Kent, very good point. So this is a perfect example. To buy JP Morgan 100 shares, you have to have $10,000 in your account, right? So in theory, you're buying actually on margin. I mean, granted, I'm only doing this for 1 day, right? Or maybe 2 days, but you are basically buying on margin, which I don't advise, right? So on a $10,000 portfolio, you know, the worst thing, you know, maybe JP Morgan would be down another 2.5%, right? It's up, you know, 4%. It could have been down 2.5%. Totally get it, right? So then you're still down $250, but you need $10,000. So I encourage you, when you're trading options, this is a perfect example where you always have to think about what is the underlying asset and how much equity do you have. When I buy 1 contract of JP Morgan, I'm trading $11,000 worth of stock. When I'm trading 1 contract of Delta Airline, I'm trading $3,100. So in theory, for 1 contract of JP Morgan, if I want to be equal weighted, you know, then I should buy 3 contracts of Delta Airline. On a $5,000 account, if the trade goes against me and I want to repair it, invest $10,000. So then maybe if you have $5,000, then you cannot trade JP Morgan. Maybe then you trade Citigroup, right? I could have chose Citigroup right? Because Citigroup, one contract is $4,400. So if you have a $5,000 account, okay, then one contract of Citigroup makes sense. Or maybe you trade Bank of America, right? Maybe you trade Bank of America because Bank of America is, $3,200. Very important question, very important statement, Ken. Thank you for pointing that out. Trader, yes, if you did 3 trades 1% and you would have lost 2.5%, you only made 0.5%. Yes, I assume I would have lost only 1%, but you're right. Worst case scenario on the Delta airline, I would have been down 2.5%. Then yes, then I would be, it would be only 0.5%. You are correct. You are correct. You are correct. But the probability of that is also when I bought it at 109 and the market continues going higher, sold it for 2.5, stock closed at 110, right? That it drops 3%. I mean, it was, no, but I was down already 2.5%, right? So I was already down 2.5%. The likelihood that I would be down additional 2.5% is low. This is an example of repairing the trade, but you're right. You're right. If you do 3 trades 1% and 1 trade 2.5, then you only made 0.5%. Fair point. Any other questions? All right, guys, you've been great. Encourage you to try out Elite Circle. We always give 30 days, no questions asked refund, right? Participate in live trading room. And if I understand, it's, I mean, it's a financial commitment. Totally get it. So hold on a second, YouTube. Search for YouTube, click on subscribe every Wednesday, morning bell and closing bell. Every Friday, we have the Strategy Roundtable. Every Wednesday, morning bell and closing bell on YouTube channel. You don't have to buy any subscriptions, right? Try it out. Just remember, it's a process, right? The story of Shackleton, one thing you can learn, what is the key takeaway? First of all, it takes twice as long as you think it's gonna take. And everything is, you can only concentrate on the process, right? You can control which day the wind is going to blow, right? Is it going to be 70 miles an hour? Is it going to be 10 miles an hour? Will it go west? Will it go east, north? You can control this, but you can control how much food you're, conserving. You can prepare where you're going to put your camp. You can control how well you talk to your, teammates, right? How, what your leadership skills. So concentrate on things that you have control over. What you have a control over, everybody can try to join on Wednesday, morning bell and closing bell. If you're busy, you have a full-time job, click on subscribe, watch the recording. Everybody has control over that. I encourage you to do this and then plot your performance when you don't watch live trading room, and then plot your performance when you do watch live trading room. I'm gonna make a statement that I'm 90% confident that your performance when you watch the live trading room and your performance when you don't watch live trading room will be significantly different, right? I'm 90% confident in that statement, and it's free. So please join. This is, I hope you will find it useful. If you do, please click on subscribe button. Please share it on YouTube channel or any other, traders community you're part of. You guys been great. Spend some quality time with your friends and family. And hopefully I will see all of you on YouTube, the 8:15 Central, 9:15 Eastern, right? Search for the word Tradespoon, ask questions on YouTube, and, concentrate on things that you have control over, right? Your thoughts and actions. Thank you very much and have a great day. Thank you, Joseph. Take care, guys. Thank you, Kevin. Thank you for the comments. Explorers Club. All right, I'll check it out. All right. Thanks, guys. Take care.